Hi, now we're going to have a look at the 2016 higher level half production half cash budget. The first thing we're asked to do in this question is to prepare a production budget for the 4 months July to October 2016. So to do the production budget, we start off with our sales. For the production budget, we need to find out how many units we need to produce. So we start off with how many we plan to sell. We add the closing stock that we plan to have at the end of the month because we need to make those also. And we take away the opening stock coming forward from the previous month. So the first thing we're going to do is to start off with just the sales units from the question. And they are coming directly from here, these sales units. So to fill those in, for July it's going to be 9,000, October 9,750, September is 11,000, November is 12,000, October is 12,000, and November is 12,500. Now we have to add our closing stock, and in the question it says stock of finished goods. Now, because we're talking about finished goods here in the first part, units of finished goods in part A, there's 60% of the following month's sales. So the closing stock in July is 60% of August. Closing stock in August is 60% of September. Closing stock in September is 60% of October. Closing stock in October is 60% of November. And closing stock in November will be 60% of December. So if we go back and have a look at December's sales, it's 12,800. And it's going to be 60% of that. Now, we don't need a column for December because this is really the only time that we use it. We're only asked to do the production budget for July to October, but we do need a column for November because we need a figure down here to work down towards a figure here. So we need to work down November down to the start of part B. And then we can forget about November. Okay, so now we're just going to add the closing stocks for each month. And then we have to take away the opening stock. Now there's no opening stock in the first month because at the very top of the question we can see that the company was only set up at the start of July, so they're only setting up business, so there wouldn't be any opening stock. And then the opening stock in August will be simply the closing stock in July. The opening stock in September, closing stock in August. Opening stock in August will be the closing stock in September. And the opening stock in November will be the closing stock in December. And they are all going to be minus figures, so we're taking them away. So I'm just going to put those in as minuses. And now I'll add down each month. Which will give us the number of units that we need to produce each month to make the required sales. Okay, so that's part A of the question done. The second part, part B of the question, is to prepare a raw materials purchases budget in units and euros for the 4 months July to October. So we need to see how many kgs of the materials we need to buy in units, and then we just multiply by the purchase price to see the quantity in euros. And again, this will be a standard layout here, so you could fill this in first and then start putting in the figures. So the first figure that needs to go in are the units of production each month, which I simply get from above here. So 14,850 doesn't seem to be working, so I'll just fill them in manually. 11,600, 12,300, and 12,680. They're the units we need to produce each month. Then it says in the question, how much materials do we need per unit? It tells us above here that we need 3 kgs of material X. So I'm just going to put in 3 for each month, and then we're just going to simply multiply those to see how many kgs we need. So if we need 14,850 units and we need 3 kgs per unit, we're going to need 44,550. And it's going to be the same for August. and September, October, and November. So they're required for production in kgs. Now again, we're going to add our closing stock and take away our opening stock for the same reason as above. But this time we're talking about materials, not units. So in the closing stock, it's a stock of materials sufficient for 20% of the following month's requirements in kgs are held at the end of each month. So closing stock is 20% of the following month's requirements in kgs. So my closing stock here is the requirements per kg of the next month by 20%, which gives me 6,300. And I just do the same the whole way across, by that by 20%. And that is the reason I worked down as far as November here, because this figure was 20% of November's required for production in kgs. And now we can finish with November because we don't need that anymore. So I'm just going to add these down now because I'm adding my closing stock. And I'm going to take away my opening stock. Again, there's no opening stock in the first month for the same reason as above. The company is just set up. And here, the closing stock in August, the opening stock in August is going to be the same as the closing stock in July. The closing stock in September is going to be, so opening stock in September is going to be my closing stock in August. And my opening stock in October is going to be my closing stock in September. And again, we're taking away the closing stocks, which gives me required for purchases in kgs. So in July, I'm going to have to purchase 50,850 kgs. Now the price per kg, I can see from the question, the price per kg is €4, and that stays the same each month, €4. So the cost in euros is just going to be 50,850 kgs by €4 kg is 203,400. And it will be the same way for the other months that we calculate that. So now we have the cost of the raw materials in euros, and that's what we are asked to do in part B of the question. Part C of the question is a cash budget, similar to the cash budget that's asked on its own in some years. So we're just asked to prepare a cash budget for 4 months, not 6, just for 4 months, July to October. So the first thing, as in all cash budgets, the first thing we're going to have to do are our receipts. So in the question, it says that the cash collection pattern for sales is expected to be, so 30% of sales revenue will be for cash, you'll get that straight away. The other 70% will be on credit, and of that 70%, 50% will pay in the month after sale, and the remainder, the other 50%, will pay in the second month after sale. So to work this out for July, I'm just going to start off with my sales. So my sales for July are 270,000. And 30% of those are for cash. So I'm just going to multiply that by 30% because I get that in July. Then of the credit ones, again my total sales are 270,000, but 70% of those are for credit. And of that 70%, I get half of it 1 month later, and then I get the other half, which will be the same amount 2 months later. Again, August, I'm just going to start off with my total sales of 292,500. So it'll be 292,500, and 30% of those are for cash, and then 292,500, 70% of those are for credit, and of that 70%, half of it, 50% I get in 1 month, and the other 50% I get in 2 months. September, my total sales are 330,000, so 330,000, and 30% of those are for cash, and then 330,000 by 70%, 70% of them are for credit, and of that 70%, I get half in 1 month, 50% of it. And in October, I just have to work out the cash sales. So in October, total sales are 360,000 and 30% of those are for cash. So I just have to work that out. And I don't have to do November and December, so I only need to work out the cash sales for October. So now I'm just going to total these down and total them across. And that gives me my total receipts. The next thing I have to work out are my payments. In the payments, it says in part V, 1 month's credit is received from suppliers. So the stuff I purchased in July, my purchase in July, I pay for in August. So I won't have to pay for anything in July because I get 1 month's credit. And then in August, I just pay for July purchases. In September, I pay for August purchases, and in October, I pay for September purchases. And then I just total those across. They'll give me my total purchases, which come to 472,920, and 0 in July. Wages. So for wages, it says that wages are 10,000 plus 5% of the sales revenue for the month. So it's 5% of sales revenue plus 10,000. So the sales revenue, if I go back to my sales for July, is 270,000. So it's 270,000, and 10% of that. So let's check with the 10%. So it's, if I go back to my wages, 5%, so it's 5% plus 10,000. So it's 270,000 by 5%, and then plus 10,000. Which is 23,500. In August, if I get my total sales for August are 292,500. So it's going to be 292,500. By 5%, and then plus 10,000. September sales are 330,000, so it's going to be 330,000 by 5% plus 10,000. And in October, the total sales are 360,000, so it's going to be 360,000 by 5% plus 10,000. And then I just total those across, which give me total wages of 102,625. Variable overhead I need to work out next. So for the variable overhead, if I go back to the question, it says variable overhead is €4 per unit payable as incurred. And now that's per unit produced, not per unit sold. So I have to go back up to my units produced, which I'll get from part A of the question. I just multiply it by 4. Same for August. I go up to the units I needed to produce in August, 10,500, and it's €4 per unit, so I multiply them by 4. In September, I needed to produce 11,600, and that's €4 per unit, so I multiply by 4 again. And same in October, I needed to produce 12,300 units at €4 a unit is 49,200. And I'm just going to total those across again to give me my total variable overhead of 197,000. Next, I have to calculate my fixed overhead. The fixed overhead, it says including depreciation is 28,000 per month payable as incurred. Now the reason including depreciation is in brackets is because we have to take out depreciation because it's a non-cash item, so it shouldn't go in our cash budget. How do I work out the depreciation? Well, I can see down here, what do we depreciate? We depreciate fixed assets. So the fixed asset they bought was equipment. The equipment cost 60 grand and a useful life of 5 years, which is 60 months, because 5 by 12 is 60 months. So if it was 60,000 and it's been written off over 60 months, its depreciation is going to be €1,000 a month. So instead of putting in to my fixed overheads 28,000, I'm going to have to take out 1,000 each month. So my fixed overheads will actually be 27,000. And they're going to stay the same each month because they're fixed. So 27, 27, 27, and again, I'm going to total those across. Equipment is straightforward. The purchased equipment, I can see down here that the equipment was purchased on the 1st of July costing 60,000. So 60,000 is going to go into July. And there's no other equipment purchase. So again, I'm going to total that across, which gives me 60,000. And then I just have to work out the loan installment and the loan interest. So if I go back to the question, it says the loan to finance the equipment, they got a loan of 48,000, which is secured at 10%. The loan and interest will be repaid over 4 years. Monthly capital and interest payments will commence in August. So I'll start paying back the loan and the interest in August. Well, if the loan is 48,000 and it's paid over 4 years, 4 years is 12 by 4 is 48 months. So if they're borrowing 48,000 and paying it back over 48 months, they're going to pay back €1,000 a month. And that's starting in August. So the loan installment to be nothing in July, not 0 in July, and then it's going to be 1,000 for the other months. And I'll total that across. That will give me 3,000 for the loan installment. And the loan interest, again, it says to start paying that back in August. And to work out the interest, well, if the loan is 48,000 and the interest rate is 10%, that will give me the interest for a year. Sorry. If the loan, just to work out the loan again, sorry, the loan is 48,000, the rate of interest is 10%. So to work out the loan interest, it will be 48,000 by 10%. That will give me the interest for a year, but we're working out on a monthly basis, so I'm going to have to multiply that by 1 over 12, which it comes to 400. And again, that's starting in August, so there's no loan interest in July. And that's going to be 400 each month, which is going to leave me with €1,600. So €1,200, because I don't pay back July. Now I'm going to total these payments down each month. To give me my total payments. Now I have to work out my net monthly cash flow. My monthly cash flow is just my receipts minus my payments each month. That will give me my net monthly cash flow. Then my bank loan. I got a bank loan in July and the bank loan was 48,000. I can see that here, the loan of 48,000 in July, so that will go in there. That will be some additional cash. And I didn't get a loan in any other month, so that will leave me with a total of 48,000. My opening balance, I'm going to have a 0 opening balance because the company is only set up in July. So 0 will go in July, and then the same amount always goes in the total column, which will be 0. And to get my closing balance, I just have to add these down. So minus 88,900 plus 48 is minus 40,900. My closing balance in July will be my opening balance in August. Again, I total these down. My closing balance in August will be my opening balance in September. Again, I'm going to total these down. My closing balance in September will be my opening balance in October. I'm going to total these down to give me minus 11,745. Now, this here will not go here because there's already a figure there which is 0, and it's not the next month, it's the total column. So I'm just going to total these three figures down. Minus 59,745 plus 48 plus 0 leaves me with minus 11,745, and I can see once these two figures are the same that my cash budget has balanced. The next thing we're asked to do is to prepare, so part D asks us to prepare a budgeted P&L for the 4 months to the end of October. And it says the budgeted cost of a unit of finished goods is €20. So the first thing I'm going to have to do is to work out my sales. So for my sales, I'm going to work out sales for the 4 months, not for the 6 months. So I'm just going to add the sales from July to October. So it's going to be 270,000, and again these are just coming from the top of the question, plus 292,500, plus 330, plus 360,000, which leaves me with total sales of 1,252,500. Cost of sales is a heading, and the first thing I have in my cost of sales is opening stock. There won't be any opening stock in this question because the company is just set up, so that's 0. For my purchases, I'm going to get from above here, from part B, which is 203,400 for July, August, plus September, plus October. Because they are in part B, I worked out the raw materials purchases for the 4 months. So I'm just going to add those to give me my total purchases, because that's what I purchased for the 4 months. So my opening stock plus my purchases gives me 621,432, and then I have to take away my closing stock. Now I have 2 different types of closing stock. There's finished goods and raw materials. So for the finished goods, again you have to be careful that we're talking about the end of October. So if I look above here in part A is where I'm dealing with the finished goods or the units. At the end of October, my closing stock, so if I go across from closing stock and down from October, at the end of October I had 7,500 units. And in the question, it tells me that the budgeted cost was €20 per unit. So for my closing stock, for finished goods, it's going to be 7,500 units by €20 per unit. I also have closing stock of raw materials. And if I go back to part B of the question, I can see that the closing stock of raw materials at the end of October, so again I get on to closing stock, over from closing stock down from October, it's 7,608 kgs. So I have 7,608 kgs, and the cost per kg of the materials, I can see at the top of the question, is €4. So to work that out, it's just going to be 7,608 by 4. So in total, my closing stock comes to 180,432, and 621,432 less the closing stock, leave me with my cost of sales, and my sales less my cost of sales will give me gross profit. So my gross profit is 811,500. Now I just have to take away my expenses. So my wages are coming from the cash budget because the wages were payable as incurred, so they're 102,625. The variable overhead again is coming from the cash budget, which is 197,000, and fixed overhead again is coming from the cash budget, which is 108,000, because they're all payable as incurred. Depreciation has to go in here to my profit and loss account as an expense. It doesn't go in the cash budget because it's a non-cash item, but it is an expense. So the depreciation we worked out earlier, we said that it was €1,000 a month because we took it away from fixed overheads. So it was €1,000 a month, and we're doing the P&L for 4 months, that would be €4,000. And the way we got the €1,000 was we divided the 60,000 by 60 months. So my expenses come to 411,625, and the gross profit less my expenses will leave me with an operating profit of 399,875. And the last thing I have to do is to take away my interest, which again I'll get from my cash budget. The interest came to €1,200, so I'm going to take away the interest, which will leave me with a net profit of 398,675. And that is the budgeted P&L finished. And part E then, there's a small bit of theory for part E, which asked us, what recommendations would you make to Irwin Limited based on the budgets you prepared? And the second part was outline the factors which Irwin Limited should take into account when estimating future sales figures. So the first thing, the advice we could give them, the recommendations we could give them, would be to reduce the requirements for closing stock of finished goods, particularly in early months, to reduce the cost of production. So instead of being 60%, they might hold a lower closing stock at the end of the month. They might negotiate a lower price than €4 per kg from suppliers when buying raw materials, and this will reduce expenditure. So if we could cut that €4 down to €3.50 or €3, it would save them some money. They may encourage debtors to pay earlier by offering discounts for early payment, or reduce the period of credit allowed from 2 months to 1 month, which will increase receipts. So if they pay by cash, they might offer them a 2% discount or something, and instead of giving them credit for 1 month and 2 months, maybe just 1 month credit. And they may postpone the purchase of the equipment in July and instead lease the equipment. This will reduce the deficit in July by 12,000 because the equipment cost them 60,000 and they only got a loan of 48, so they must have paid 12,000 themselves. And if they leased out the equipment, they wouldn't have that cost. Part II, and again, part 2 of the theory part says what factors should they take into account when estimating future sales figures. So when they're estimating future sales figures, they might do some market research and check trends or opinions of sales reps, as they may be a reliable indicator of potential sales. So they'd be most qualified to talk about that. What is the price to be charged for the product or service? They need to work out the price to be charged. Is the level of competition in the marketplace intense or not? So the higher the level of competition, probably the lower they might have to charge. And is the economy expected to grow over the coming months? So there are some of the questions that they might ask. I hope you found the video useful, and if you did, I hope you might subscribe to my YouTube channel. Thank you.